Hello and welcome to the look ahead for Thursday, the 8th of May, with me, Fiona Cincotta, Senior Market Analyst at City Index. Tomorrow, we'll be watching out for the Bank of England interest rate decision. In the US, we've got US jobless claims. As far as earnings are concerned, we'll be watching Coinbase and Shopify. But let's just kick off with the Bank of England interest rate decision. Central Bank is expected to cut rates by 25 basis points, taking the rate to 4.25%. This will be the fourth time that the central bank has cut interest rates since the start of its easing cycle in August. So the interest rate decision comes as the market is pricing in around 94 basis points worth of rate cuts from the Bank of England this year. We had been sort of looking at potentially that slow and gradual, careful and gradual rate cuts from the Bank of England, which is what they'd sort of signaled to. However, quite a lot's changed with the announcements of Trump's Liberation Day tariffs. Obviously, the worst case scenario has been avoided, but still 10% increase in trade tariffs is still expected to potentially slow global growth. We're also expecting that to have an impact on the UK economy. And as a result, the Bank of England could signal or could potentially be cutting interest rates at a faster pace than originally expected. That's what the market's going to be watching out for. Will the Bank of England be indicating that they may increase the pace of rate cuts this year? Potentially the removal of the phrase gradual rate cuts from the statement would be something to watch out for. Now, obviously, it's worth keeping in mind that this rate decision is coming after the Federal Reserve this evening. We haven't had the Fed rate decision at the time of recording this. Fed is expected to leave interest rates on hold at 4.25 to 4.5%. And so what we're expecting is potentially the Federal Reserve to lean into a slightly more hawkish stance, in which case we might find that GDP USD starts to struggle a little bit. Obviously, we've had that run up from the 2025 low up to the 134, just short of 134.50 high at the end of last month. Since then, we've fallen back. We're trading around the 133.60 level right now. But if we hear a slightly more hawkish Federal Reserve and a slightly more dovish Bank of England, then the pound US dollar may struggle to get back up to that 134.50 high. Obviously, that does depend also on what's going on as far as trade talks are concerned, particularly with regards to China. Any sense of an escalation in the trade war may have a negative impact on the US dollar, in which case cable could find itself moving higher. But if we're just talking about central banks, what's going on with central banks, then that could be potentially slightly dovish for the pair. Just also to keep in mind, as far as inflation is concerned in the UK, inflation has been cooling. Wage growth is still sticky, but I just think this potential for the outlook for the UK economy, if we just have a look at PMI data recently, that came in below expectations. Service sector has gone into contraction as a result of the uncertainty surrounding the Trump's trade tariffs, but also we're seeing problems caused by the hiring. We're seeing weakness in hiring owing to the Labour government's budget, which has increased the tax burden on employers at the same time as increasing the minimum wage. So that's what we're looking for as far as pound US dollar is concerned. Sterling, if we just have a look now, this is the FTSE. FTSE recovered from that low. We've run into that high there at the 86, 87, so just below the 8,700 level. Longer lower wick. Since then, it's been coming under pressure. I mean, if we do see that the Bank of England adopts a slightly more dovish approach or stance, then that could be beneficial for certain sectors within the FTSE, thinking house builders, domestically focused sectors like retailers as well. That's what to be watching out for. But as far as the technical picture is, we're just seeing that pull away from that upper level. RSI is still over 50. We're still above the 100 and 200 SMA and also the falling trend line. So the uptrend is still intact from this recent recovery. Do need to get a move over that 8,700 level in order to extend the rally back up towards the 8,800 and 8,900 fresh record highs. Just finally, going to look at the NASDAQ. Obviously, this is being recorded, as I said, before the Fed rate decision this evening. Again, we've seen that recovery from the low. However, it's run into resistance there at the 200 SMA, just over 20,000. So you've got this resistance zone here, which is between 220 and 2000 and 2200, which it failed to really push above. Again today it's failed to push above that 2000 level, so we're still below the 2000. If we hear a slightly more hawkish sounding Fed, then we could see a fall back towards the 19,300, which is the 50 SMA, and also part of this support zone here. So I hope you've enjoyed what I have been talking about. If you have, then please do give this video a like, and otherwise I will see you tomorrow.